Okay, good afternoon, everybody. Today is Friday, December 9th. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Please take a moment or two to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. We don't provide investment advice, buy, sell, hold strategies. Can't tell you, if you're should buy or sell your Apple, if you should be a day trader, if you should be a long-term investor. Our sweet spot, our circle of competence is research and education. Okay, so I'll have some market thoughts, and included in the market thoughts, we'll do the indices. Then we'll explore the industry groups, some stocks to watch, and then the quote of the week. It's been a couple of weeks since I did this. The Friday after Thanksgiving, I took off, and then last week we have our monthly webinar, which kind of covers the market. So I usually take that Friday off unless something drastic has happened. So here we are, we're getting near the end of the year. It's getting a little quiet, but the markets are still jumping around. So let's look at the indices to start. And here is a chart of the NASDAQ. Now the market's been closed for about a half hour, so the price action should be pretty relevant. It was the market opened lower on some inflationary news. Honestly, I don't even know if it's PPI, CPI, API. I just, came in, the indexes looked like they're going to be higher. And then there was, when you see a really large bar like that, then it's some kind of news. And then the market spent the rest of the day coming back. And then in the last kind of 45 minutes, it melted down again. So it was a tale of three different markets. So here's the open, a huge bar up, and then at the end, this is 60 minutes, but you can see like in the last 10 minutes is kind of gave back a lot of the gains. So not much of a day. You're above this 50-day, which is good, still below the 200-day, which is bad. And the relationship, like where the S&P is, you see the S&P poked its head above it. It couldn't hold for a day or two. The NASDAQ never even really got close. So there's a real underperformance on the NASDAQ. And then if we include the Dow now, you can see how strong it is. It's way above the 200-day, well, way above comparatively. So it's a real strange bifurcated market. Let's use this comparison chart. I'm curious. So if we start the year, January 1 of 2022 till now, here's the Dow, down 7% for the year. Just because it's easy, I don't want to use the, oops, I was going to add the SPY, but let's go ahead and add, not from a list, I apologize, but let's add the S&P, which is down 17% year to date. And then let's add the NASDAQ, which is down 29% year to date. So, they will bifurcate usually almost every year. They're going to be slightly different. This seems unusually large, the difference in performance, but it's been a very unusual year, that's for sure. So, and it's a calendar year, which besides like the tax thing is really, it's very arbitrary, right? The market's constantly moving. If we go, I'm curious, like, let's just pick March 1st of 2020. And you can see how strong the NASDAQ was versus those indexes. And then it's really lost its performance since then. So since March 1st of 2020, The NASDAQ is up 28%, the S&P up 33, and the Dow up 31. So NASDAQ has given back all of the outperformance that it had in that, the 2020 COVID bull market. So this comparison chart can be very interesting. How do you find this in MarketSmith? Let me close it. It's in the upper right corner of the regular charts. I call it the house window. It's the 4 black windows up there, and you just pull that up. You can change the date. You can add a bunch of different symbols and just kind of compare their performance to each other. So Dow best in breed, S&P second best, NASDAQ last but not least. International markets are shaping up a little bit. Here's emerging markets, still below the 200-day, but not as far below versus like the NASDAQ. And Chinese stocks, which were uninvestable down here, are suddenly not so uninvestable after, almost 17 to 31 is what, 80% move. Just an incredible move in an index like this. Just to kind of go off the rails a little bit, this was the leader, and I honestly kind of missed the boat. I knew this was a buy, but I just had been avoiding Chinese stocks for so long, but it just felt like there was unusual strength here and here and here, and I just passed for whatever reason. So DTH, which is Wisdom Tree Equity Income Index, has a yield roughly 5% and change, and you can see it's above the 200-day as well. So it's really very changing, a lot of cross currents, a lot of undercurrents in the market, things that are strong while the averages are weak, things that are weak while the averages are strong, and it's just constantly sloshing all around. It's been a crazy year. I think I've mentioned before, this is a year for survival. You just, at this point, especially in December, I'm just trying to get through this year and survive it. It's been an okay year. I feel like I should have done a lot better than I did because I've identified a couple of home runs, like the Tesla short, but I've gotten hit in other spots. And energy, which was really good, has kind of lost its luster, and it's been a tough year. So we'll see what 2023 brings. I don't have any predictions or anything that makes me kind of say, oh, I think it'll be a bull market, I think it'll be a bear market. I mean, if you're going to force me to make some kind of decision about markets, I really think that the indexes are not going to go anywhere for a long, long time. What does that mean? A couple of years of just sideways, up and down, up and down. But within that, there could be some really good trades. And when I mean trade, not a day or two or three, but like months to years. And there could be some really big winners in that environment. You look at the 70s when the Dow didn't make a nominal high for 20 some years. I look at these model books that I have, and there's just tons of stocks that went up 100, 200, 300%, way more than you would ever think, because a lot of them don't exist anymore. So it's out there for you. It's not easy. You'd rather have the wind at your back with the market, but there will be, I'm certain, some outperformers. And this year there's some really shipping stocks, the solar stocks, and some energy stocks have done really, really well. So there was opportunity to perform this year. And just for full disclosure, I do own DTH. I don't own any of the other indexes that I mentioned, but I do own DTH. I like the yield. I like the relative strength of it, and I think the U.S. has been best in breed for years and years and years, and I've been wrong for a long time, thinking that the money could slosh, and it's like a seesaw, right? The money will go where it's treated best, and it's been treated best in U.S. markets for a long, long time, but that's not always the case. It seesaws, and I've been waiting for the seesaw to switch sides and been wrong. But maybe this is something that you have a tiny little bit of change. You can see that, like, this index, although it does have a great yield, I don't know if it's been paying roughly 5% for years and years and years. If that's the case, then really, from a money standpoint, you're up here somewhere, or maybe there. But it hasn't been a nominal high since the great financial crisis, the GFC. So I think there's upside in something like this, and it's the contrarian in me, it's hated too. I love a market that's hated, that's at or near new highs. Now, this isn't quite there, but this looks like a double bottom to me. There's your pivot. That's where I was buying. And as long as it can hold, it's not going to go up, $1 a day like a Tesla or NVIDIA, but it's also hopefully not going to go down $1 a day like a Tesla or NVIDIA. It's a little bit different type of strategy. Okay, let's jump to some slides that I wanted to talk about. And I have quite a few because it's been a while since I have, or been a couple weeks since I did this. So here are the strategists and their targets for 2023. It's a tough gig, I think. I wouldn't want to have to do it. I just don't know how you can even guess, but there are strategists out there that do this. And here's the spread between the high and low on their targets for the S&P in 2023, next year. So you can see in 2009, that huge bar, and that was how far away the highs and lows were. And that was because 2009 was just coming off that massive bear market. So there's a lot of uncertainty. And we're back at those levels. So really very uncertainty. Most of the time, the strategists just extrapolate linearly, is that a word? They extrapolate in a linear fashion. And they just stack on 15% or 12% or whatever, like markets would ever do that over and over and over. And that's how they kind of get surprised. At least now you have some people that are very uncertain on both ends of the spectrum. Some strategists think we're getting to a big bull market, and some strategists that think the bear market's going to continue. So there's a high degree of uncertainty out there on Wall Street. I really like this chart, and I can't apologize. I can't remember where the source was. I always like to list the source because I think it's only fair. I didn't create this chart, obviously, but you do hear all the time, and I was a stockbroker, we used to hear this all the time when I started out, that you don't want to miss the best days in the market, because if you do, you lose all the performance. And it's mostly factual. If you miss the 10 best days, you can see the lowest performance number, excluding the 10 best days, versus the middle one, which is the S&P, the light blue. You've lost a lot of performance if you miss just the 10 best days in S&P history. But nobody ever talks about the other way. And so I really like this. If you were to exclude the 10 worst days, look at your performance. Look how strong, how much of a factor in performance just those 10 bad days are. Now, admittedly, it's hard to miss the 10 worst days. But if you could somehow miss 2 or 3 or 4 of the 10 worst days, and in that process, you might miss 1 or 2 or 3 of the 10 best days. But it looks to me like it's better to miss a few of the best days in combination with missing a few of the worst days because of the chasm in performance. Yeah, I'm looking at this scale. It looks like about 200 for the 10 best days. It looks at about maybe 5 for the S&P, and you're looking at about 13 for excluding the 10 worst days. So it's kind of why we have a sell strategy, why we do what we do with the markets. It's not easy trying to interpret the overall market action, but there's a reason that we do it, because it can, if you could somehow avoid 1, 2, 3, 5 of the 10 worst days, it will really save you in performance. Here is margin debt, year over year margin debt. And when margin debt collapses, you're usually at or near the end of a bear market. So this is actually a good chart from a bullish standpoint. You can see in 2000, the margin debt collapsed. Now, the market kept making lower lows. It's not a timing indicator, but it tells you that the speculative fever has kind of left the market and there's no more forced selling. A lot of what happens a lot of times, you get forced sellers. That selling feeds on itself on the way down. And then you lose those same people who are willing to use margin to go back into the market. They're not there anymore. So it's harder for you to get these, really large gains back up. And so it just feeds on itself both ways. I have to admit, I haven't used, well, the only reason I've used any margin this year that I can think of is because, in essence, to be short a stock, you use margin. And I will use margin in one of my accounts, but most of my accounts are cash accounts, and I don't obviously cannot use margin in like IRAs and Roth IRAs. So, but I haven't had the inclination that, boy, I really wish I had more margin. And too many times this year, I've always, I feel like sometimes it's been the opposite, like I've been overexposed. So you're losing that speculative fever for the market, and that's that's in the margin debt is a good sign of it. That's the red line. It's coming down really hard. Now, if you go back and look in 2000 and 2008, it didn't mean that the market stopped going down, but you were close. Close meaning months, but that's fine. We are, in my humble estimation, I think the bear market started in March of 2021. So we are almost 2 years into it. I think it was a stealth bear market at first. If you use the indexes, I think the indexes topped in November of 2021. So we're a year into it using the indexes. And now you're getting the margin coming down. So, maybe there's light at the end of this tunnel next quarter, the quarter after that, something like that, based on a lot of the historic numbers. Historically margin, historically how long a bear market lasts for, historically how much it goes down. We've kind of reached those numbers for the NASDAQ and the S&P especially. So if the low is in, if it never makes another low, it went down enough to qualify as a bear market for sure. You might hover around in these areas for a while, never make a new low, and then finally, you get that bull market that starts. I hemmed and hawed about showing this chart. I don't know how it really would add any value. Is there any value add for my trading by looking at something like this? And I thought about it, and the answer is, I think no. But it's good to think about these things. I think I like to think about the macro and trade the micro. So interest expense on the debt is getting, look at this chart. Now I know maybe there's some chart crime here. I didn't go through any of the scaling or anything. I just, cherry picked the chart exactly as is, but it looks, it looks pretty climactic. And I don't know if you guys have noticed, I saw today that store credit cards are like 30% interest rate. That's incredible. I don't know how that can even, I would think that would be illegal. But I had a credit card that was a 0% introductory rate that expired. And when they sent me my new statement, I couldn't believe the interest rate was over 20%. And so I couldn't call them fast enough and tell them, go ahead and pound sand, politely pound sand and keep this credit card. I mean, close it, close the account. I didn't have hardly any balance on there. I just paid it off and said, close it. So it could be a headwind from, if you're thinking about certain types of sectors, certain types of stocks. I know Lululemon didn't have a great report today, was down 10 or 12% last I saw. Another macro thing. And so the percentage of forecasters who believe we're headed for a recession in the next 12 months is as high as it's ever been, and it's not even close. This is a really good chart, because how far back it goes, but you've never had anything close like this. So this is according to this headline, I like the headline, the most anticipated recession ever. So for me, when I see something like this, my spidey senses tell me that either one, we don't have a recession, or two, maybe it's very short-lived and nobody really notices, or three, it's really bad. That would be awful. That would be the worst case scenario. In other words, most people saw the recession, but they didn't see how bad it would be. But something seems like it has to be different than just your garden variety recession in 12 months, because everybody sees that coming. All right, and this is the performance of a hedge fund. I'm pretty certain it's a hedge fund, and I've blacked out the name of the fund because it's not relevant to what I want to discuss here. They've had a tough 2022, as you can see, down 70%. And what I wanted to highlight here, what jumped out at me is the assets. AUM is assets under management. You can see in 2011, 2012, 2015, or actually they opened in 2014, it looks like. But the AUM was basically nil. In other words, probably just friends and family, a few $1 million. They were up 17% in 15, up 3.9 in 16, up 28 in 17. So, very good, very good performance, I think. I mean, look at what the S&P did in those timeframes. So they're doing better than the S&P. In 2017, the S&P had a good year, but they did slightly better. In 2018, the S&P was down, and they were down more than the S&P, but they didn't dig themselves a big hole. Down 15% is something you can dig your way out of, and they did. In 2019, the S&P was up 31, they did 41. So they outperformed the market, but where they really hit the ball out of the park was in 2020. And the S&P was up 18%, and they were up 222%. Now, I want you to notice where all the AUM comes in. Where does that chart get hockey stickish? In 2020. So the money always comes in after the fact. So it was very few people recognized their performance. I would have thought by like 2015, 2016, 2017, they're doing a very good job. 2018, it's okay. It's not terrible. 2019, they did a very good job. They should be getting money. Money just doesn't come in like that, unfortunately. That's kind of the same thing that you would see for ARK, is it hockey sticks. It rushes in after the fact. So they do 222%. The money rushes in. 2021, they're down 15%. Now, 15% to be down, I don't think that's that big a deal, except there's one red flag here. The S&P was up 30% that year. So the other year they were down 15%, the S&P was down 4%. Now, I think that's fine, especially if you're running a high growth, highly concentrated portfolio. If you're down 3 times the S&P, if the S&P goes down 20, can't be down 60. You just can't do that in this business. Maybe you can do that in your own account if you have total conviction in your names, but you can't do it in the business because you won't be in business long enough to capture the next wave up. So the S&P was up 28%. And they were down 15. What happened in 2021, right? Well, ARK topped in February of 2021. What does ARK own? Well, they owned all the high growth stuff, the Carvanas, the Twilios, the Zooms, the DocuSigns, the Teladocs of the world, and they all went down. 2021 was kind of really a stealth bear market in growth stocks. And it's reflected in their performance. And now this year in 2022, with the S&P off 23, they're down 70%. And unfortunately, all the money is down and down a lot because of when it came in. And you'll see this a lot. Even Fidelity studied Peter Lynch's Magellan Fund and found that, Magellan did X amount, 15% a year for 10 years. I don't know what it is. I'm just making these numbers up out of thin air. But the average account did 5% for 10 years because the money always came in when things were good, and then it lost its nerve when things were bad, and rinse and repeat. So it's kind of this history just repeats over and over with these with the same stuff. So I always get nervous when you see a fund or a strategy or a sector or a person getting a lot of money and people believe that they have, the new way to do it. History says that's unlikely. There's been very few, maybe Warren Buffett, maybe a Stanley Druckenmiller, but there's very few that can do that consistently on big money. Is the market changes, and a lot of times it's hard for them to change. All right, so let's open up MarketSmith and let's get into the industry groups. So Oil and Gas Royalty Trust is still number one, has been for a while. Contract manufacturing. So there's been a few stocks in there that have done really well. It's been kind of snuck up on me, to be honest with you, but I don't remember owning too many stocks there. Energy, solar, machinery, farm, very few stocks, 7 of them. The straw that stirs the drink is Deere, and Deere has done really well. Let me turn off my camera so you can see the charts better, just in case. Computer networking. I'm gonna pull this up a little bit too. Software education, retail. What I'm noticing, and you've probably noticed it, and it's been felt in the market for the last couple of weeks, is oil and gas. Remember how littered it was with oil and gas? They've kind of lost their way. So here's transport pipeline, which is the last, besides oil and gas royalty, the last of the Mohicans here with oil and gas. Oil and gas has really kind of lost its way. And you had a bit of kind of alligator jaws is what I would call it, where oil, the commodity, is going one way. And so here this is USO. It's a proxy for the price of crude oil, down 31%. And XLE, we'll just use that as a proxy. Now it's had a bad week, but for a while there it was at new highs, while USO was not. And let's use that comparison chart. So here's XLO. Let's add USO. And let's just do like, oops, not that. That would be a little bit too close. Uh-oh, I messed it up. I think lost its mind when I used this same date. Oh, froze on me. I'm gonna have to relaunch it. Sorry. Bear with me here. I need a minute. All right, sorry about that. My browser semi-crashed. You can see here from June 8th till now, USO is minus 31%, XLE is minus 10. Let's add in like Exxon minus -1. So oil's been doing this, and mostly, although, you know, this is a shorter term chart, they've been holding up. You can see USO topped here, and XLE made a second high. USO topped, Exxon made 2 other highs. So they were hanging in there, and now they're just kind of, they can't take at some point, one of them has to give. The relationship is too strong. Either USO would have had to have gone up, or it looks like what's happened is the stocks are now starting to give. You can see XLE broke the 50-day. Schlumberger, which is something that I was targeting, broke the 50-day. Tidewater, holding a little bit better, but still right there. And then some of the shippers, which were really some of the best stocks to own. This is a really great day for Frontline. I was like, wow, that looks really good. And in the morning, I was like acting really strong. And then it's like they just pulled the rug, on it. So it really changed. It's like out of nowhere, which is, one of the things we talk about. You have to be quick to change, unfortunately, with these. And Sting, which is, wow, what a great stock. It's barely even budged. TNK, another great one, actually looks a lot worse. The Sting is just like a rock. That's been one of the best stocks to own this year for sure. And I think I owned it here or here and got shaken out here, or I might have owned both of them and got shaken out there. And then I was in Spain on vacation when that happened and never, just didn't get back in. Ugh, that's a tough one. This has been a really good stock. So I don't know. There's really not a whole lot of places to hide in the industry groups. It's really hard to know. Some people emailed me and said, Scott, you talk about some of the stocks that led, but what about the new leadership? And my answer was, yeah, what about it? Where is it? I would love to know where it is. I don't know. I don't know where it is. I'm searching, I'm scouring, I'm open to where it is. I think if it's going to be growth related, my instinct is semiconductors and or biotech will be the area. And if it's going to be value related, like is VTV and DTH going to lead a new bull market? VTV is the Vanguard Value ETF. You can see holding up much better above the moving averages. And DTH was that one that I mentioned. I don't own VTV. I have owned it before. I owned it down here. I didn't hold it very well. I should have kept it. That's a whole nother video. So I don't know where the new leadership is, which is why I'm constantly looking at the industry groups, looking for seeing what's making new highs, seeing what's out there. my instinct, if you're going to force me to think of something, I think it's going to be biotech, because that's an area that could have amazing earnings power if they, if you get a new drug, new product, things like that. And so I'm watching XBI to show some strength. Maybe a stock like SWAV, which has made a big move monthly and needs to consolidate, but it has earnings power like this. Maybe it just needs to grow into the earnings, because I know like US Surgical, which doesn't exist anymore, but US Surgical is an incredible stock that just went on and on forever. Intuitive Surgical, I mean, look at that. Just this is, dollars to 200, 300, and, went through a couple rough patches right there. That's the great financial crisis. But even here, you had a little bit of a base building period. And so maybe that's something that Suave is going through. It's hard to know. So, but I love semiconductors. I think that can be an area because they have tremendous earnings power. So maybe that's the area. And I feel like every great bull market in 95, one of my biggest winners was a semiconductor stock. In 99, Intel was a great stock. There was other networking stocks. What else? NVIDIA in the most recent period was AMD. So almost always, it seems like there's got to be at least one or two really good semiconductor stocks if you're getting some type of growth bear market. So ASML looks very interesting. Full disclosure, I do own ASML. Looks like it's building. Just look at that tightness right there on the weekly. That's very, very interesting to me. ACLS, I think, made a new high today pretty much. It's probably very close to a closing high. I don't own this. I have owned this one before, but that looks very good. And there's some others in the group. AMKR. Let's go to the weekly. So that one looks really good. ALGM, which is a new name, 1, 2, 3, 4, 5, 6, 7 weeks in a row. And the thing about semis is they actually, when they're good, they actually have earnings power. So there's earnings and revenue there. What about On Semi? It's okay. And MTSI, I don't know if I know that one. So I'm guessing that we would probably need some kind of leadership in semis if it's going to be growth related. So that's an area that I watch very closely to see if we can get, there's AEHR, which is very small. And it's a little volatile, but you know what? At or near new highs. You look at the weekly, you look at the monthly, it's, I don't know, it's the highest it's ever been. So that's and then I can't think of if there's another one. So semiconductors would be, like if I could vote for a big new bull market to start and what would lead it, I would vote for semis. It would be the easiest one to identify. There's lots of them. If we go to the group, semiconductor equipment, in this case, stocks and group, show all component data. There are 29 of them. What about the other semiconductor group? NVIDIA Electric Semiconductor Fabless. Or how about I just do this? You see sector right there? So we've got equipment, we've got manufacturer, we've got fabless, but stocks and group for fabless, there are 34. And the other sector, I can't think of an example of that. To use stocks in sector right there, 99. There's a lot of options, a lot of possibilities as far as leadership. What else? I think I talked about oil stocks losing their luster, the shippers. If we're going to get a new bull market, it'd be cool if semis led. What other stocks could I possibly want to talk about? I guess we can. I know it would be the dead horse, but let's talk about the big boys. Tesla. You know, I don't know if it's a short or not. Full disclosure, I am short it. I don't know if it's a short or not. It seems to be acting a little bit better. Like today was, most stocks were down and it was up today, up 5. So I don't have a lot of conviction in it. Maybe the trade is over. It's gone down a lot. I have a relatively small short position just because I think it can go down more, but I have to respect the price action too. I don't want to be quote unquote stupid about it. Tesla, Apple looks waterlogged to me. Looks waterlogged. Amazon looks waterlogged. Even worse. Microsoft, waterlogged. What else is there? Google. So there are some new products out there which are kind of neat. Like Amazon has a down ETF, AMZD, and it's not levered, which is good because the leveraged ones get distorted. Like Tesla has a levered up ETF 1.5 times, and it's just going to bleed to death. Tesla could go up and this could go down because if Tesla doesn't go up fast enough. These levered ones, they're fun for a day or 2 or 3, but I just don't know how you can hold them for a really long time due to the constant rebalancing. But Amazon down. Well, I like to look at this stock. Would this be something that I would want to be if I was would I want to be long something like that? Yeah, going up like that. Now let's go to the weekly. You see it's you've got some tightness right here in this area. So, that would tell me, well, I don't want to be long Amazon if the Amazon down one looks like it's going up. Or Apple down, AAPD. Looks like it's just building a little base. So the daily. Now these are relatively new, but fast forward 6, 9, 12, 15 months from now, you have a lot more price action and they can tell a pretty good story. So, it looks like it's building a base. You could draw a trend line down like that. Think if that broke that to the upside, that probably means that Apple's going down. So you have to watch these even if you're not in them because they're going to move the indexes. Apple, Google, Facebook, Meta, Tesla, NVIDIA. Now, NVIDIA is holding up a little bit better. It got hit really hard, still down 50% almost off the highs. But I think this is actually, if I heard correctly on a podcast today, 50% off the lows, 108 to 170. Yeah, more than 50%. So it's credible how the math works. It really is. It's just so interesting to me. Down 50%, yet 50% off the lows. Let's see what it doesn't. It just seems so weird to me. It's really very interesting. So they're going to move the indexes, so you kind of have to watch them. And what made me think of the comparison chart is I was going to show this early on, and I decided I would jump to this as stocks to watch. But somebody tweeted that Texas Roadhouse had outperformed Google since 2015, and I thought that's impossible. I mean, they did tweet it, so they must have vetted it. So I put it into the comparison chart, and you can see since November 2015, Texas Roadhouse is up 170 some percent, and Google's up 150. So they don't have to be fancy businesses to make money. Earnings, sales, margins, they can compound on top of each other, especially if there's some consistency to it, which I've never been to a Texas Roadhouse, so I can't really tell you much about their business. They must be doing something right if the stock has outperformed Google. There aren't any Texas Roadhouses in Orange County, California, unfortunately. All right, so let's jump to the quote of the week. Help me out. Quote of the week. Here we go. George Soros. Hopefully he doesn't need any introduction. Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. So this fits very clearly with like the disagreement among the strategists on what 2023 will bring. The recession, the fact that everyone is predicting a recession. How will you make money? Well, you can't really, I guess maybe there's like a betting market where you could bet on a recession, but if there is a recession, it seems unlikely you could make a bunch of money because everybody already knows there's a recession coming. So it's relatively priced into the market. So how are you going to make any money is on something different happening, change. So you have to be willing to look for that change. That's where things happen, especially when the changes occur with stocks or industries that haven't been doing anything for a long time, and then suddenly they perk up, and those stocks are making 52-week highs. 52-week high is kind of a contrarian play, especially the very first 52-week high. Very few people want to buy the very first 52-week high after a number of years of sideways. Now, NVIDIA making 52-week highs for years and years and years in a row, it's not so, it's more obvious now, but that's why we look for stocks making new highs. Something is changing that's causing that. And the Chinese stocks, perfect example, uninvestable at the lows. Now I don't know if anyone's come out with a new report that they're investable or not, but they're 50% off the lows as an index, just looking at KWeb. That's incredible opportunity if you could have identified that. So I'm kind of kicking myself on that, because anytime I see the word uninvestable, I think, well, that's a sign that something's could change, and even the slightest change could lead to a big move. Now, it was Chinese stocks. I wish if I would love to see, when our market, if it went down so much that people said that it was uninvestable, or there was so much uncertainty in the market that it was uninvestable, then you would know that, you're pretty close. I'm reading Barton Biggs's book, Wealth, War, and Wisdom. And after, and I've thrown myself, I've called an audible here. So bear with me, because I want to get the numbers right. But in 1942, remember the war was going on in 1942. Yeah, according to Ibbotson Associates, the small stocks, I don't know what they used in small stocks. I doubt the Russell 2000 existed back then, but I'm just quoting from the book. Small stocks gained 44.5% in 1942, right in the middle of the war. The market turned after the Battle of Midway. It's like the market knew the Battle of Midway was the turning point in the war. And in 1943, small stocks did 88%. In 1944, they did 53%. And in 1945, they did 73%. It is incredible. Couldn't believe these numbers. I hope they're right, is because that type of amazing opportunity exists when you get this type of uncertainty that we're going through. Now, our markets didn't go down as much, so the snapback is probably not going to be, I don't think you're going to get that type of action to the upside. I hope I'm wrong. That would be awesome if that happened. But even half of that would be incredible, half of 44, 88, 53, and 73. But that's the key, is to be ready, to be willing to accept that things are changing, and to watch and recognize when you see those changes. Okay, I know this video was very long. I don't know how long it was, but it felt long. I had so much to say because I hadn't done one in a couple of weeks. So I appreciate it. You guys are great. If you need to get a hold of me, you know, I appreciate all feedback, good, bad, or indifferent. Sometimes people give me negative feedback about this, that, or the other, and it's all good. You know, we can all learn together, and you know, I don't think I've got this down pat. So as long as you guys believe there's value add in these videos, I will continue to keep doing them. I like them. The preparation that goes into it, even though sometimes I feel like it's a little bit off the cuff, I don't practice it beforehand, just because I believe in the authenticity of it. But I do prepare. Lots of thought goes into it. I grab screenshots. I think about what I'm going to say as I build it week by week. So as long as you like, if there's value add to it, great. If not, no harm, no foul. It's Friday afternoon. I could be out playing golf or playing racquetball or doing something else. So it would be fine to me too. MarcusSmith@investors.com, 800-424-9033. Have a great weekend, everybody. And we should be good for next week. We're getting near the end of the year, probably one or two more of these, and then we'll call it a year. Have a good one, everyone. Bye-bye.